Welcome to TheoTrade. This is Don Kaufman. Here we are. It's March 15th, 2017. Well, Janet Yellen and the FOMC came out today. As expected, raised the interest rate by a whopping quarter point. Markets, they apparently liked it, which there's a number of very, very surprising items on the screen that I'm going to point out. And then I'm actually going to show you a possible kind of trade opportunity, well, really two different trade opportunities that are going to become very viable here in the next day or two. So first and foremost, taking a look at the S&Ps in today's trading session, decent amounts of volume over here right at this time frame. Again, this is 11 a.m. Pacific. That's the FOMC announcement. Obviously, markets explode higher on that. So as I said, well, what is surprising about the FOMC announcement? To me, it's not about the way that the S&Ps per se reacted. So what? The S&Ps are up 20. We've seen this a lot lately, right? It's the fact that the S&Ps exploded higher, but so did the bonds. And when it comes to an FOMC announcement, listen, this is the market that really matters. The bonds were trading higher all throughout the course of the morning. They were rallying. On the FOMC news, they explode higher. Then they dip hard. Then they explode, back higher over here, but we're 1.5 points higher on the ZB. Now, time out for a second. Those of you that have actually followed us here at TheoTrade, I've been very bullish on bonds. And, okay, frankly speaking, I've been wrong, all right? And here, finally, when they say, all right, interest rates are going to go up, bonds rally. Now, far be it for me, but when bonds rally, that actually takes interest rates down. Meaning that it's, like kind of a, buy the rumor, sell the news when it comes to interest rates. That is, the bonds sell off, okay? Because everybody knows that there's going to be a rate increase. When the rate increase is actually announced, the bonds bounce. But neither here nor there. Again, the bonds, that's not what's too staggering to me. The one that's really got me today, and I've seen a lot of crazy stuff over the years. The bonds are up. The notes are up big, almost a full point move up in the notes. And yet the XLF, the financials, are almost completely, unimpeded. Meaning that, for the most part, when you see bonds rocking like they are today, the bonds rallying like this, that is about as negative as it gets. And here we are into the bell right now, but that's just about as negative as it gets when you see the bonds rallying. The XLF, which are the financials, they're interest rate sensitive products. There's the closing bell. But this is an interest rate sensitive product. So when the interest rates fall, which is exactly what happened today, and let's just go to the XLF. And the XLF is ending the day down a whopping 4 cents. Take it over to TNX, okay? TNX happens to be, well, the interest rates. Clearly, this is one of the largest moves that we've seen, in recent times. They dropped from almost 2.6% to 2.5%. So the 10-year drops back down to 2.5%. That should have dire effects to the XLF. It doesn't, okay? The other aspect that I just, again, can't get this one out of my head. It really, really resonates with me. How do you get the S&Ps up 18 points? The SPX up almost 20 with the fact that the financials, really one of your largest sectors in the S&P 500 is actually down in the day. So I've been looking at this throughout the course of the day, almost shaking my head. You realize you have the financials weak and you have technology. That's IT next to it. IT is, the largest sector out there. The two of the largest sectors, they're actually the weaker sectors. And yet you have markets exploding higher. Now, over here, what do you have on the right-hand side of the screen? That happens to be real estate. And you can kind of follow along right up over here on your screen. And again, I'll kind of highlight it. The different sectors will actually be positioned here. As I kind of mouse over, you'll see the different sector back over there. But again, that's real estate. Real estate, minute, Here's energy. Now, again, I said there's two trades that I am looking for in the days to come. One of them, listen, I'm already in it. I'm short the XLF. I like the short XLF position because, frankly, I think bonds are still going to rally. Why do I think bonds are going to rally? Eventually, the S&Ps are going to turn around. When the S&Ps start turning around, the bonds rally. That's one possibility, okay? But the reality with bonds, why do I think the bonds are really going to rally? I'm going to come back to the bonds for just a second, because the bonds rallying really is a trade unto itself, right? Obviously, I've been very much bullish on bonds. I have positions in bonds, I'm bullish on bonds, right? So why do I really think the bonds are going to rally? Because our interest rates, okay, do they really have room to explode higher here in the US? And, I was talking about this a little bit on TheoTrade, kind of live throughout the course of the day, but here's the point. This is the TNX. And again, we just pulled this up a moment ago, but the TNX happens to be the 10-year rates. And when you look at, this is, again, this is the interest rate now, which is sitting right around 2.5%. I know it says 25, but this is actually, in quoted, about 2.5% on a 10-year, okay? That's on a 10-year. Now you look at the rest of the world, and the rest of the world being, okay, ECB, which is the European Central Bank, or you look at like Bank of Japan over here. Do you realize that both, okay, these entities have a tremendous amount of quantitative easing still going on, all right? So the ECB is tapering off their program. The Bank of Japan hasn't done anything. The Bank of Japan still has like negative interest rates. The ECB still has a lot of bond buying that has been in negative interest rates. How do our bonds just, the interest rates, what do you think it's going to go up to like 3%? Because then everybody, okay, from Europe and everybody from Japan, you know what they do? They borrow, okay, ultimately from what? The Bank of Japan. And what are they borrowing money at? Let's just put a crazy number. Let's say they're borrowing money, okay, at 0.5%. They're going to borrow money at like 0.5%. They're going to dump it into the 10-year here in the US. But if you go out and start buying the 10-year in the US, what does it do? Well, if everybody starts buying it, what does the bond do? The bond rallies. As the bond rallies, it takes the interest rates lower. There is a parity trade in here. And what that ultimately means, okay, when these interest rates here in the US start jumping and like, let's call it 3%, okay, there's a trade that'll actually go on. And this trade, again, people will call it a parity trade. People will call it a carry trade. I don't want to get into the definitions over here too much because I don't want to lose anybody, but it's a very simple idea. Rates, I don't think they're going much higher in the US right now, no matter what the FOMC does, because the FOMC is controlling the very short duration rates. They have the capability of controlling the 10-year. They're not doing that right now. But to actually control the 10-year, okay, what that ultimately does is it entices, okay, other borrowing, all right, from, again, like Bank of Japan over there, and we could mention, again, the ECB. They'll borrow capital for next to nothing, bring it into the US, buy the US bonds, okay, because anything is better than what they're getting. Like, again, Bank of Japan, you're like, I can get 0.5% for what? For 10 years. So why not just borrow capital here in Japan, all right, assuming this is the Bank of Japan, bring that capital right in here. All right, that's supposed to say Bank of Japan, bring that capital right in here to the US. And what it does is actually takes rates to the US and brings them back down. And that's why I'm very long term, I'm actually still bullish on bonds when the rest of the world is turned on it. Now, in addition to that, as I'm bullish on bonds, yes, in turn, I am very bearish inside of the financial product. And today is a prime example. Listen, the XLF, and I'll be very clear about this. I've actually been bearish for quite some time on the XLF after, the presidential rally over here, okay, in the neighborhood of the 23.5, okay, and you've been wrong. I've been wrong. There's nothing wrong with that. This is a little bit of a longer duration trade where I want to take a bearish position inside of the financials based on the fact that, again, I think bonds still have room to run to the upside. Now, I would not suggest doing both of those trades. You either take the short position in the financials or take the bullish position inside of the bonds. If you're not comfortable trading bond futures, use the TLT. You could use different spreads in the TLT. And that's predominantly what I have been doing, is using different spreads in the TLT in addition to, of course, buying bonds. On top of it, I'm actually short a few thousand shares of the XLF. Thanks, everybody, for joining us here at TheoTrade. I'll be back on the TheoTrade chat room all throughout the course of this week. Again, we're seeing a little bit of volatility in the markets, but it's not over, okay? Still some volatility to come on Thursday or Friday this week. Stay tuned. Have a great evening. Bye-bye.